Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Eric Balchunas, Senior ETF Analyst at Bloomberg Intelligence and co-host of Trillions podcast. We're talking about the top ETF stories of the first half of 2021 and the outlook for the second half. Eric, welcome back on the show and thanks so much for joining us.
Yeah, thank you for having me. Glad to be back.
Okay, so after a remarkable run in 2020, stocks have continued their rally in the first half of 2021, and all three major indexes are now trading at or very close to their all-time highs. They have defied fears about valuations, Fed tapering, and inflation, and in fact, this was one of the best first halves ever for the S&P 500 index, and it has been a great first half for ETFs as well. More than $450 billion has flowed into ETFs so far this year. And a lot of that money is going into equity ETFs, unlike last year when bond ETFs also got a lot of investor cash. And we have seen that retail investors jump in and buy each dip in equity markets. They buy stocks, they buy stock ETFs, and probably we can thank retail investors for the rally this year. So I wanted to start with your thoughts on the recent market action and these massive inflows into equity ETFs.
Yeah, I think that's all very astute observations. The interesting thing that we've seen this year is, first of all, just the amount of flows. Last I checked, which was this morning, I'm really into this stuff, was about $464 billion into ETFs year to date. That's almost an annual record, and we're halfway through the year. So they're they're a virtual lock to blow away the record. The question is, could they possibly take in $1 trillion in a year? Probably not, but $800 billion, $900 billion would be amazing. That's about a $4 billion a day pace. Now, where's the extra money coming from? I do think that the ETF structure and the value proposition it offers is good for about $1 or $2 billion of those dollars. People just switching over, just like the way you switch from CDs to streaming or MP3s back in the day. The other the other billion or two that's coming in my opinion, is really coming into what you tapped into, which is the equity market. But in particular, it's the stuff that had been lagging. So the metaphor we're using this year is sort of like, it's like a basketball team where the bench players are finally scoring. And what I mean by bench players would be value, small caps, emerging markets, even commodities. All these things had not really pulled their weight over the last 5-10 years. And now they've come roaring back. And so the breadth in the market, where those things can actually start participating and doing well, while at the same time, growth and the S&P and the sort of stuff we've been used to for 10 years hasn't taken too much of a hit. It's still up. And so it's kind of a real utopian situation, I think, right now, which makes me a little nervous. We've seen how you get lulled into this sort of feeling of complacency and I don't know what the word is, like you're insensitive, and then bam, there's this major market thing, and so I don't think volatility is gone. I think it just sort of hides away for like longer periods of time these days, and then comes roaring back. But for now, that to me is the story of the year.
So over the past decade, we have seen this trend of mutual funds losing assets and ETFs gaining assets, and more than $460 billion this year so far is awesome. So recently, Dimensional Fund Advisors, DFA, they converted 4 of their tax-managed mutual funds with about $30 billion of assets into ETFs. And with that move, DFA became one of the top 15 ETF issuers. And I saw your note predicting that in the coming decade, more than $1 trillion worth of mutual fund assets could be converted into ETFs. Talk to us more about that.
Yeah, the idea of conversions we're very bullish on this. I think I'm the most bullish of all of my analyst peers, and I'll tell you why. When you look at the ETF world right now, another trend we see in flows is that most of the flows, in fact, maybe 90% of the flows, even more, go to one of two things: dirt cheap or shiny objects. And this is because portfolios are now reshaping, and we call it barbelling, where you might have a real low-cost vanilla core, which might be 70% of your portfolio, maybe 80. That's boring stuff. You don't want to touch it. You're just sort of buying and holding. The fees real low. And then you go crazy with the other 20%. You add on hot sauce. You take chances. And that is where, theme ETFs have done well. ARK has done well. That's what we call the shiny object lane. The problem for legacy mutual fund companies is they are neither cheap nor shiny. And they are used to sort of being the core of your portfolio and charging 70 basis points for the active management. And they take little bets around the index. But the problem is they have been replaced by Vanguard and index funds over the last 20 years. So they either have to get real cheap to justify the fact that you're getting mostly the S&P 500 plus some bets, or they're going to have to go and get really active. And they're just not doing that right now. The active non-transparent ETFs that have been launched are, mostly around the index. Maybe their active share is like 50%, maybe 70% even. But what people are looking for is 95%. And their fees are between 40 and 80 basis points. And that's why they've been completely ignored, despite massive brand names like Fidelity, T. Rowe Price. So that is kind of an embarrassing scene, to go and enter an ETF and you're this big popular company and like nobody cares. I think that conversions make a ton of sense for them because you can come over with assets, which means you come over with dignity. You open up with billions in assets and you just kind of look like a player. People don't blow you off. And then you've got a situation where you also bring over your track record. So you're active. And so in your track record, you might have a better chance of getting onto platforms and that kind of thing. Because you can show that. And in addition, the investors who were sitting there in your mutual fund, they come over and now they've got more tax efficiency. And I think a lot of the gains that are built up in the mutual fund can ultimately be washed out in the new ETF wrapper for those investors once the conversion is done. So think about that. It's a real win-win. The asset manager gets to keep their fee and their dignity and their track record. And the investor gets to have less capital gain, probably no capital gains distributions, and wash out the gains that it's currently sitting on. So to me, there's too much benefit there. There are some kinks to iron out, like with 401k plans, but the lawyers I've spoken with and the people who have converted are pretty confident those can be worked out. And these are deep-pocketed firms. I think with their money and their willingness to do this, they'll also sort of like create the motivation to help work this out. So that's why I'm bullish on conversions. But even $1 trillion converted over 10 years would only be about 10% of all mutual fund assets. So I think I could even be conservative in that estimate, but time will tell.
Excellent points. And since you mentioned ARK ETFs, let's talk about ARK Bitcoin ETF filing, which was the biggest ETF story this week. This was breaking news on TV. And this was, in fact, the 12th Bitcoin ETF filing, but none earlier than this got so much attention. And it makes a lot of sense because Cathie is a Bitcoin bull. She has talked about Bitcoin going to $500,000, and she has a lot of exposure to Bitcoin through GBTC or indirectly through Coinbase in her ETFs. And some investors were really hopeful about a Bitcoin ETF approval this year because the new SEC chairman, Gary Gensler, he had taught classes on blockchain at MIT. But, those hopes have come down after some of his comments because he has expressed a lot of concerns about the challenges and gaps for investor protection in the crypto markets. So talk to us about your thoughts on the ARK Bitcoin ETF filing. And do you think we can see a Bitcoin ETF this year?
I wish I could say yes on the Bitcoin ETF. I've become a little more bearish over the past 2 or 3 months. And the reason is because I really think the SEC is in a tough spot. I think they know that an ETF would work fine and be a much better choice for retail investors than some of the other possible tools and products that are out there. The problem is there's really big forces inside the US government and people who are very powerful who have a real problem with crypto. And so we looked and we just examined the quotes and the language from people like Janet Yellen, the Treasury Secretary, Jerome Powell, head of the Fed, Elizabeth Warren, and even Biden. Biden hasn't said anything directly that I could find, but there was some language in a budget proposal about making Bitcoin more transparent. There's possibility about taxation. But Elizabeth Warren in particular and Yellen were both very concerned. They think there's pump and dump problems. They think it's inefficient. It's got the climate issue. And so our opinion now is that the SEC probably would like to approve it, but they can't until the government as a whole does more in terms of providing a regulatory framework or a crackdown. And so I think the ETF delay is a sign of that way bigger issue. And so I pushed my approval date into next year, unfortunately. Now, ARK is really actually a smart filing because, ARK is going to buy a Bitcoin ETF when it comes out. It would obviously get rid of GBTC and it would go into the Bitcoin ETF. And why not just use your own? Might as well just pay yourself than pay somebody else, although they'd probably waive the fee knowing ARK style. And in addition, I think the other interesting thing about ARK is that Cathie is on the board of 21 Shares, which is an European ETF issuer. And that's really who the issuer here of this product is. ARK is just the marketing agent. And 21 Shares have all kinds of Bitcoin and crypto, many different types of crypto ETFs in Europe. They're very progressive. If there's one firm that it was like the tip of the spear of like crypto ETP products in the world, it's 21 Shares. So she's partnering with a really good company. And she is also going to be able to save a little money by using her own fund. And frankly, a lot of people who are invested in ARK are younger and of the crypto mindset. So she could actually end up with like one of the biggest Bitcoin ETFs when all is said and done. So I'm very bullish on her fund. I'm just bearish on the approval being this year.
Yeah, I agree with you. This could be the biggest Bitcoin ETF, if and when they are approved. I also noticed that this was the only Bitcoin ETF filing that mentions the fee, 95 basis points. So do you think that 95 basis points would set the standard for other Bitcoin ETFs?
Yeah, I think that's about right. I think when you look at the leverage ETFs, the VIX ETFs, the products that are trading tools, they're all about 80 to 100. So I would assume it's in there. It's going to happen though. Somebody's going to come in and offer one for 40 basis points probably and try to quote vanguard the category. So there will be some cost pressure. I just think that this is the type of category that's probably a little less price sensitive. However, if they're all doing the same thing, which is tracking the price of Bitcoin, you could find some people, especially in the advisor world, who are like, well, might as well just pay 40 instead of 100. But at first, what's going to matter more is your brand. And how much liquidity you got, like which products does the liquidity really kind of form around? That will be a big deal. And also, like, you're going to find people launching Bitcoin ETFs like who are really popular within the Bitcoin community who may be able to draw on their own clientele. And that might be, it's going to be interesting to see who does well in this race. Is it going to be a traditional ETF issuer like Van Eck or Wisdom Tree? Or maybe somebody like Valkyrie, who is a little more in the Bitcoin world. It's going to be, like I said, this is something that our team thinks about a lot and like basically debates. But I do think 95s, I would bet that's, around the average for the first 2 years or so.
So talking a little bit about ARK ETFs in general, ARK was the top ETF story of 2020, and their tremendous success turned Cathie into some sort of a cult figure, and her ETFs did not do very well earlier this year because investors, they were rotating out of 2020's stay-at-home winners into more cyclical areas of the market, but most of her fans stood by her even during the downturn. And ARK ETFs have started doing well. Her flagship fund, ARKK, is now up about 30% from its March lows, silencing Cathie's haters. And you have been tracking ARK performance and flows very closely. So I was interested in your thoughts on ARK ETFs, rebound and inflows.
Yeah, so I want to give myself a little pat on the back because when ARK was going through that really nasty drawdown, starting, I believe, like March into May, where it went down 35%. That was like it's a pretty severe drawdown. We were not defending her per se in that, oh, this fund will never go down. We never said that. What we did say is that it's dangerous to bet against her. She's really just has a knack for like this era and picking companies that do well. The second thing is people sometimes view her active strategy through a 1990s lens. They think like, oh, it's a Janus 20, oh, it's a Fidelity, whatever, where that would be the core of your portfolio. And so when the fund started to have a bad run, people would panic because, oh my God, this is my core equity position. What am I going to do? And they would go and try to find a better manager or put their money in cash. Well, as I mentioned earlier, people are barbelled now. So they've got the core covered with their cheap Vanguard, which they're not selling. We know from the flows, nobody sells Vanguard and, BlackRock ETFs during sell-offs. They just don't. And they use now, Cathie would be like, again, the hot sauce, the add-on. Well, if a fund like that isn't your core position, you're going to have a little more tolerance for the drawdowns. You're like, well, I get it. This is supposed to be volatile. It's not my main position. I can handle this. So in the course of that 35% drawdown, ARKK actually took in $1 billion. And I felt like we nailed that call, and we made it when it was tough. That wasn't an easy call to make because, you start to see these headlines coming out. Oh, she's in a bear market. The fund's down, 20%. But keep in mind, people tend to just zoom in on the last like 2 weeks or 1 month, or they trace you from all-time highs. I don't like that. I call that all-time high shaming. I mean, Bitcoin gets the same treatment. I'm like, wait, okay, fine. It's down 20% since all-time highs, but it's still up like 200% in the past year. I think you have to zoom out sometimes and be like, well, of course, the fund's not going to go up forever. Nothing goes up in a straight line. So, but her corrections tend to be about 30%, but over the long haul, she seems to come out of them. And she's very convicted on her CNBC interviews and Bloomberg interviews when the going was getting tough. She's like, look, I'm happy the prices are lower for these stocks I like. I mean, I think her investors respond to that. I think they want that. They want her to stay the course. They don't want her to like sell these more high octane stocks and move into the more boring stuff because, again, they've got the boring stocks covered in their Vanguard fund. So to me, this is the mindset and the psychology that many people miss. And finally, I would say is in the 90s, a lot of people were put into active mutual funds by brokers because they got paid by the fund in the form of a load or distribution fee. Cathie's investors found her. They bought her fund on purpose and they're in their own account. And that also, I think, that will give you a little more loyalty. So again, I wouldn't view Cathie through a 1995 lens, and I think that showed in the past, sort of sell-off. And now she's up 24% in the past 3 weeks. So the bounce back is in effect.
I totally agree with you. And this has been a great first half for ETF launches too. And we have seen some very interesting ETF launches, and some of them have been very successful in gathering assets too. Cathie's Space ETF was probably one of the most successful. ARKX has already gathered more than 630 million in assets. Buzz ETF, which was promoted by Dave Portnoy, also generated a lot of buzz, and this has gathered over 250 million in assets. So which are your favorite new ETFs of 2021?
Oh, good question. I get asked this sometimes, and if I'm not like literally looking at the new ETFs, I honestly I forget. There's so many. They come out like there's one a day that launches, and I'm tasked with covering this stuff, and I can't keep up. But I'll give you a couple. I mean, the one that just launched this week, Vote. It's the engine number one Transform 500 ETF. Most ESG ETFs go out there and they score stocks based on their ESG-ness and okay, fine, you're going to be overweight tech and underweight energy, and they all kind of have that feel. I've never been into those, frankly. I don't know, most people I know still use a ton of oil to get around. I don't know why you wouldn't want to own a stock that you are a customer of. That's one thing. But the other thing is energy just had a big rally this year. You missed it. You didn't own any of those stocks. I think the better way to do ESG is to work, talk to the companies like Vanguard and BlackRock that you're an index fund holder of and say, hey, look, can you try to vote in a way that, because you have actual power. I don't think Amazon or Exxon cares if their stock doesn't make an ESG fund. There's just not that much, maybe a little bit. But anyway, I think that the engine number one is going to try to use their relationships with BlackRock, CalSTRS, Vanguard, these big, the muscle, the owners of these stocks, so they can propose something and then basically go after names like stocks that they want to, I don't know what the word is, like not fix, but, move forward. And you'll be able to hopefully tap into the voting power of Vanguard and BlackRock. So the metaphor we use is a tugboat. So engine number one would be like a tugboat in that they would be able to pull these big, gigantic owners of stocks into some of their proposals. And so it's almost like you're buying this fund and you are paying 5 basis points. So again, it's Vanguardian cheap, but you get the activism on top of it. And their track record is really good. They know what they're doing. They had a huge win with Exxon that nobody thought was possible. So that is a fascinating launch. I find that's probably the better way to do ESG if you're into changing the world. The question is, does anybody really care? Is this just like a New York, LA kind of issue? And like most people honestly could care less about ESG. We're going to find out soon the answer to that. So I think Vote also is going to help us answer some questions about people's desire to do ESG. We also really enjoyed QQQJ. This is one that launched from Invesco. It's simply the 100 stocks that are on deck to get into QQQ. This is one of those launches where you're like, I can't believe this didn't launch 10 years ago. So sometimes, you'll see a launch where it's like, oh, that makes a lot of sense. We also like this Simplify ETFs. This company is really up and coming. They have these ETFs that buys really far out of the money calls and puts to give yourself a little zip on the way up if there's a spike rally and a little protection on the way down if it crashes. It's sort of like they've designed the ETFs to basically not have that drag. Sometimes downside protection ETFs have a drag to them, but these are so far out of the money that they don't drag much. It's not that doesn't cost that much to buy those options. But because we're in this situation I mentioned earlier where volatility tends to like just hide away for years, but when it comes big. And then a lot of times it swings back the other way. March 2020 is a great example. So these are the kind of funds that they're launching that are able to sort of give you that kind of downside protection while not really limiting your normal delivery of beta. So those are some of the, I guess, interesting ones that stick out to me, just top of mind. I'm sure if I look through a list, I would have some other ones, but those stick out. And of course, Buzz, but you went over that one already. I will say this, Buzz and Gerber Kawasaki is coming out with one. We have a note coming out next week where we're looking at how it's possible an ETF becomes like the new business card where, if you're a famous financial person or an advisor, you just put an ETF out with your stuff as just a way to get yourself out there, to market yourself. Not necessarily it's your whole business, but it's a way to sort of package your whole thing. And anybody can now participate in you. And Cathie Wood showed that people do like to follow a manager. And so I think the idea of having an ETF that people can check the holdings every day and really participate, it could be interesting where we see some, I don't know what the word is, like ETFs become part of the marketing of certain financial celebrities and advisors.
Yeah, definitely all very interesting products. And I wanted to talk a little bit about the outlook for the second half too. Now, most strategists believe that the stock rally will continue into the second half, boosted by strong economic recovery and earnings growth. And this appears to be a Goldilocks scenario of strong growth and easy monetary policy. So I was interested in your picks or the ETFs that you're watching for the second half of 2021.
Yeah, I guess I would look at value and commodities. I just talked about value's comeback, and what we noticed is, and I talked about Cathie's fund ARC gaining 24% in 3 weeks. Well, what happened 3 weeks ago is that there's an interesting reverse regime change. It looked like value and small caps were going to sort of lead the year, but it all shifted back to sort of that 2020 growth tech trade 3 weeks ago. So I don't know. I'm so confused by this because I don't know if that's just like the last gasp of that growth tech trade having one good last rally, or was this value comeback just one long head fake? And I don't know. So it's going to be interesting because value ETFs have taken in $54 billion. Their old record was $30 billion. Think about the fact that if growth takes over again, a lot of the money is going to come out. It's possible value ETFs could have taken in $50 billion and then lost most of it by the end of the year. That would be something. That's one of the things I'm watching, is to see what happens in the value growth area. That also would, bleed into the sector area. And then commodities, I've always been skeptical of commodities, especially ones that hold futures like PDBC, which holds like natural gas oil futures. But I just looked, this thing's $6 billion, taking in $2.3 billion today or this year. That is crazy. Commodity ETFs, the broad-based ones, have already broken their annual record in flows as well, just like value. So I'm also watching those. Commodity ETFs will tend to do well if people have inflation fears. And so I think you got to watch those for how people view inflation. I'm torn on whether, how real inflation is or not. I can't say I'm an expert in that area, but I don't know. I don't totally see it around me, but I see some of the numbers, and I just think commodities will help, clarify that, because the smart money will start to move out of commodities if the inflation fears subside. You know what I mean? So those are some of the things I'm watching. Obviously beyond the typical, the SEC providing more guidance to the Bitcoin ETF, which is obviously a major theme of ours. So I guess those would be some of the areas we're looking at.
Excellent stuff. And that's all we have time for today. Eric, thanks again for joining us.
Thank you for having me.
So that was Bloomberg's Eric Balchunas. I hope you enjoyed the conversation. Eric, in fact, posts a lot of informative, good stuff on Twitter, and I definitely recommend that you follow him on Twitter if you're interested in ETFs. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast, and also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@sachs.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.